I've been doing a little bit spring cleaning on my portfolio lately. More specifically, I've been selling stocks that I have little conviction in, and at the same time, I've been buying stocks that I have higher conviction in. In a sense, I'm trying to concentrate my portfolio on stocks that I'm most bullish on over the next few years. And so today, I want to share with you three of those stocks, all of which I just recently added to my existing positions. These are stocks that make a significant portion of my portfolio, so I'm putting my money where my mouth is. And so without further ado, let's talk about stock number one, which is PayPal. PayPal pioneered digital payments over 2 decades ago and is now one of, if not the largest fintech company in the world, offering digital wallet services for consumers and payment processing services for enterprises. The company also owns Venmo, the largest peer-to-peer payment app, as well as Braintree, which is one of the leading global payment service provider. Now, PayPal is more of a turnaround play, and as you know, the stock has been struggling lately, down more than 80% from its all-time highs. So I want to talk about some of the reasons that led to PayPal's massive sell-off, and then I want to talk about some of the reasons why I think PayPal is a great turnaround play. So first, why is PayPal stock down so much? Well, one of the biggest reasons is that the company as a whole is growing much slower than it used to, as you can see right here, primarily due to lower take rates and the reopening of global economies after the pandemic. As you can see, PayPal's revenue growth was as high as 20 to 30% a few years back, but now it has stabilized at just mid to high single digits, which got a lot of investors thinking, you know what, maybe PayPal is not a high growth stock anymore. Maybe PayPal doesn't deserve its premium valuation anymore, and that's why we see the sell off in PayPal stock. And the sell off is further amplified by the fact that PayPal is losing customers. As you can see, active accounts growth has been slowing down over the last few quarters, with growth turning negative in the past 2 quarters. As of Q4, active accounts was 426 million, down 2% year over year, reflecting the churn of unengaged accounts. But on a positive note, monthly active accounts grew 1% year over year to 224 million, so PayPal is retaining and expanding more engaged accounts, so that's great to see. But nevertheless, the growth slowdown in active accounts within PayPal's ecosystem is still concerning, since it's an early sign that PayPal might be losing market share to competitors. So growth is slowing down, and to make matters worse, PayPal's gross margin is declining as well, which is an indication that PayPal has low pricing power. In Q4, gross profit was $3.7 billion, basically flat year over year, representing a gross margin of 46%, which is down 400 basis points year over year from 50% last year. And as you can see, gross margin was as high as 58% a few years back, but now it's just 46%, which does not look good at all. So gross margins declined due to the outsized growth of its unbranded processing business, which grew 30% in 2023 as compared to the branded checkout segment, which grew only 6% year over year in 2023. So unbranded processing has lower take rates than branded checkout, and because of the much faster growth in the unbranded processing side of the business, PayPal's total take rate declined as well, which leads to lower gross margins. However, take rates might have bottomed in Q3 as seen by the sequential improvement in the metric in Q4. So the new CEO Alex Chris has pointed out a few times that the company will be pricing its offering to value and focusing more on profitable growth, which means that we can expect gross margins to improve from here, and if that happens, I think we can see the beginning of PayPal's turnaround story come into play, which leads me to some of the positives about PayPal stock. First, the company is still processing a ton of payment volume at about $1.5 trillion in 2023 alone. So despite the slowdown in revenue growth, PayPal's total payment volume or TPV growth has been accelerating over the last few quarters, as you can see right here. In Q4, TPV was $410 billion, up by 15% year over year, mainly driven by a 29% increase in unbranded processing TPV. So as long as PayPal is driving strong TPV growth, PayPal has a good potential to grow earnings, The key here will be improving monetization down the road through better pricing, which is what the new CEO intends to do. So, another reason to like PayPal stock is due to the company's growing engagement despite the decline in active accounts. So, here we have PayPal's number of payment transactions, transactions per account, and transactions per account excluding PSP or payment service provider, which is unbranded processing. As you can see, payment transactions was 6.8 billion, up 13% year over year. Transactions per account was 58.7, up 14% year over year. And transactions per account excluding PSP was 33.5, up 7% year over year. So every single metric is growing strongly, showing strong engagement within the PayPal ecosystem. So while active accounts are down year over year, PayPal maintains strong engagement within its platform, which also means that PayPal is retaining more engaged, higher quality accounts, which is what really matters. Another good thing about PayPal is that the company is growing earnings per share quite rapidly. As you can see, non-GAAP EPS reached an all-time high in Q4, which was $1.48, up 19% year over year, driven by operating leverage and share buybacks. Time and time again, history tells us that the long-term performance of a particular stock is directly correlated with the company's EPS growth. So as long as PayPal continue to drive earnings growth, I think the stock will eventually follow earnings growth, which is up and to the right. Now, the bad news is that management guided for zero growth in non-GAAP EPS in 2024, which might have destroyed investor confidence. However, the good news is that management's guidance includes a minimal contribution from the innovations they recently announced. In other words, management is sandbagging their guidance, which means that we could expect PayPal to outperform expectations in 2024, which could push the stock higher. Speaking of which, PayPal stock is still trading at deep value territory, which is one of the biggest reasons why I like PayPal stock. As you can see, the stock trades at an EV to revenue multiple of 2.1 times, which is a major discount from its peak of 16 times. And not only that, PayPal stock also trades at a PE ratio of 16.8 times, which is a massive discount from its peak multiple of 109 times. That being said, PayPal stock is trading at its lowest valuation multiple ever, which offers a very wide margin of safety and a very attractive risk to reward profile for investors today. Even management knows that the stock is cheap, which is why they bought back $5 billion worth of stock in 2023, or about 7% of its market cap of $69 billion. And not only that, PayPal still has $10.9 billion of share buyback capacity left, so I expect management to keep buying back shares at these prices, which should accelerate earnings per share growth moving forward. So in terms of price target, analysts have an average price target of $72, which is an upside of about 12% with a street high of $145 a share. As for me, I have a price target of $107, which is about a 60% upside from its current price of $65 a share. If you want the details and assumptions for my valuation model, you can check out my PayPal article, which I will leave the link in the description box below. That said, considering its status as the most popular payment method in the world, considering its recent management changes, considering strong fundamentals, and considering depressed valuations, I think PayPal is a very attractive turnaround play right here. Now let's move on to the second stock for today, which is Grab stock. Now, I recently made a two-part video about Grab stock, so I would highly recommend you watching that videos as it gives you the full picture of why I'm really bullish on this company. In a nutshell, Grab is one of, if not the most popular tech company in Southeast Asia, offering on-demand delivery, mobility, and financial services in the region. You can basically think of Grab as the Uber of Southeast Asia, as the DoorDash of Southeast Asia, and the Cash App of Southeast Asia. Grab is an absolute monster in the region, having leadership positions in mobility, deliveries, and financial services in Southeast Asia. So Grab has over 5 million plus merchants and 5 million plus drivers under its platform. More importantly, Grab has a huge consumer base of 37.7 million monthly transacting users, and that user base is still growing, recently up 12.2% year over year in Q4. So 37.7 million monthly transacting users is a lot. But that's still small considering that Southeast Asia has a total population of nearly 700 million, which means Grab has only a market penetration rate of 5.5%, which means that there's still so much room for growth, especially given the fact that Southeast Asia is still a developing region. Now, here's why I like Grab stock. First, the company has strong competitive moats. According to Morningstar, there are five types of sustainable competitive moats, namely intangible assets, switching costs, network effect, cost advantage, and efficient scale. And based on my research and analysis, I think Grab has all five of them, which is very rare for any company to have all five. I have already talked about this extensively in a previous video, so I won't go into detail into Grab's modes, but the point is, I think Grab has one of the strongest competitive advantages I've ever seen in a business, which is why I'm confident about the long-term prospect of the company. In addition, Grab is growing revenue very rapidly. As you can see, revenue has been ramping up over the last few quarters at 653 million as of Q4, which is up by 30% year over year. This is primarily due to a 9% year over year growth in GMV and a 4% year over year decline in incentives. So keep in mind that Grab recognizes revenue by taking GMV, multiplying it by the commission rate it sets on its platform, and then minusing incentives paid out to consumers and its merchants. But just to keep it simple, Grab is growing GMV and monetizing its user base more effectively, while at the same time paying out less incentives such as discounts, and that leads to strong revenue growth that you can see right here. So GMV up, incentives down leads to revenue up, and that's what I love to see from Grab. And we're seeing improved monetization across all four segments. As you can see, deliveries revenue is up 20% year over year, mobility revenue is up 26% year over year, financial services revenue is up 102% year over year, and enterprise segment is up 124% year over year. And keep in mind that Grab still has a long growth runway ahead as the digital economy in Southeast Asia is set to expand even more over the next decade, as you can see by the charts right here. So this secular trend alone is going to be a massive tailwind for Grab. Additionally, all four segments' profitability are improving as well. Here we have adjusted EBITDA by segment as well as their margins as a percentage of GMV. As you can see, margins are expanding across all segments, and only the financial services segment is unprofitable at the moment. But that's okay because management is investing heavily in the fintech opportunity in Southeast Asia, which I think is going to be massive. And also take notice of how high margins are for the enterprise segment, which mainly consists of advertising revenue. And I think this segment could be a major profit driver in the future as it scales further. So this is very exciting times for Grab. But the big picture is that profitability is improving across the board. And that led to Grab turning GAAP net income profitable for the first time ever in Q4. So Grab recorded a net income of $11 million in Q4 with a 0.2% margin as a percentage of GMV, which expanded 800 basis points year over year, showing very strong operating leverage within the Grab ecosystem. So prior to Q4, Grab has pretty much been operating at massive losses as it was heavily investing to acquire users, launch new products, and expand geographically. But now the story has completely changed as the company turned profitable for the first time ever. And not only that, Grab has a fortress balance sheet with a net cash position of about $4.25 billion as of Q4. And to give you a little bit perspective of how large that is, $4.25 billion is more than 30% of its current market cap of $13 billion. And I expect its net cash balance to continue to expand moving forward as the company improves profitability and cash flows. And management has already said that free cash flows will improve substantially in 2024, so expect better days ahead for the company. So at first, I wasn't really bullish on Grab stock. I know that Grab is this Southeast Asian tech giant because I live in Southeast Asia. I know that this company has a really strong competitive positioning in the region, and it is basically a virtual monopoly in Southeast Asia. However, it was only after the company turned profitable that got me interested in Grab stock. And to make things even better, Grab stock is still down nearly 80% from its all time highs. So, valuation wise, I think Grab is extremely undervalued. As you can see, the stock now trades at just 3.7 times its revenue, a significant discount from its peak multiple of 32 times and average of 7.3 times. Analysts are also very bullish on Grab stock with an average price target of $4.65 with a street high of $7, and that represents an upside of 39% based on the current price of $3.33. And as for me, I have a price target of $6.47, which is nearly double from the current price. If you want to know how I get to this price target, you can watch my deep dive video on Grab, or you can read my Grab article on Seeking Alpha, which I will leave the links in the description box below. That being said, despite being a fundamentally stronger company today, I think Grab stock is still significantly undervalued, which is why I started a position in Grab stock a month ago. Moving on, the third and final stock that I've been buying aggressively is none other than SoFi. So, SoFi is a very popular growth stock in the investing community, and it is basically one of the fastest growing fintech companies in the US, offering consumers financial services such as digital banking, student loans, and stock investing, just to name a few. It also operates a separate financial technology platform called Galileo, which offers enterprises with financial services such as card issuing, payment processing, and digital banking. In essence, SoFi is disrupting the banking industry, rapidly taking market share away from legacy banks such as JP Morgan, Citibank, Bank of America, and so on. And this is reflected in its growth profile over the last few years. As you can see, SoFi's revenue has been growing at a very fast clip, growing at triple digits in 2020 and 2021, and then moderated to 50% plus in 2022, and now it has come down to 30 to 40% plus over the last few quarters. In its latest quarter, revenue was 615 million, up 35% year over year, with all three segments, namely lending, tech platform, and financial services, all growing year over year, with the financial services segment driving the majority of SoFi's growth, which grew its revenue by a whopping 115% year over year. Yes, some of you might say that growth has been slowing down, but that's normal given that SoFi is growing over a much larger base. And besides, a 35% growth for a mid-cap company is still very impressive in my opinion. Not only that, but SoFi's member base continues to expand aggressively. So the company ended Q4 with 7.5 million members, up 41% year over year. In Q4, the company added 585,000 new members quarter over quarter, which is well above its quarterly guidance of 500,000, which shows how great SoFi's products are and how strong the momentum is for the company. And I always say this, user growth is one of the most important metrics to track because the number of users on a platform is technically a leading indicator of future revenue growth. And to see strong member growth on the SoFi platform means that we can continue to expect strong revenue growth moving forward. Also, of important note, based on a total population of about 341 million people in the United States, SoFi's 7.5 million member base means that SoFi only has a market penetration rate of just 2.2%, which means that the company has a long growth runway ahead. And given the company's current momentum, I won't be surprised if SoFi gets to 10% market penetration within 5 to 10 years. And one day, I believe SoFi will be a top 10 bank in the US. So I tweeted this the other day and it shows SoFi's ranking as a commercial bank in the US. And this ranking is by total assets according to the Federal Reserve. And as you can see, SoFi's ranking has been improving over the last 8 quarters from being the 449th largest bank to now being the 75th largest bank by the end of Q4 last year. So very strong progress for SoFi, and I think it's only a matter of time before the company become a top 10 bank. And I think this alone is the biggest bull thesis for owning SoFi stock. Additionally, SoFi is already profitable on a GAAP basis. In Q4, SoFi turned GAAP profitable with a net income of $48 million, dollars, representing a net income margin of 8%, which expanded by 1,700 basis points year over year, demonstrating strong operating leverage within the business, which is really great to see. Here we see the same thing for SoFi's adjusted EBITDA, which is a close enough proxy for the company's operating cash flow. In Q4, adjusted EBITDA was $181 million, dollars, representing an adjusted EBITDA margin of 30%, up 1,400 basis points year over year. And do note that management's long-term adjusted EBITDA margin target is 30%. So to see the company achieving its long-term target this early is just incredible to see. And not only that, but incremental adjusted EBITDA margin was 74% in Q4, which means that for every new $1 of revenue the company generates, SoFi subsequently makes 74 cents in adjusted EBITDA profit, which is just insane. In other words, SoFi's overall margin should improve as the company scales revenue further, which should lead to robust earnings growth moving forward. While growth and profitability look really strong, management guidance was quite soft, which is probably why the stock has been struggling as of lately. For the full year 2024, management expects combined tech platform and financial services revenue to grow by 50% or more versus 2023 levels. In addition, they expect lending revenue at about 92 to 95% of 2023 levels, which implies negative growth for the lending segment. All that is to say, management expects growth to slow down materially in 2024, which to some investors may mean that SoFi's growth story may be weakening. However, keep in mind that management is just being conservative with their guidance, with the assumption that GDP is expected to contract in 2024, with unemployment rates increasing to as high as 5%. In addition, management is intentionally limiting lending growth below its level of demand and capacity. Furthermore, management is assuming no significant new business launches or acquisitions in their outlook, with growth entirely coming from existing businesses. So, put simply, management is sandbagging their guidance in a really big way. And given their track record of strong execution, I won't be surprised if SoFi continue to outperform expectations in 2024. Even so, they still expect earnings per share to grow to 7 to 8 cents and tangible book value to grow by 300 million to 500 million, which means fundamentals are set to improve further. Whatever it is, despite management's soft guidance, I think SoFi's outlook this year looks stronger than ever. For one, SoFi has been busy forming new partnerships. For instance, the company recently partnered with the NBA to become the official banking partner of the NBA. With over 210 million followers across various social media platforms, the NBA is one of the most popular sports league in the world. Another example will be its recent partnership with the National Association of Realtors, which is the largest real estate association in the United States. In addition, SoFi also recently partnered with Wyndham Clark, who is currently the number 4 ranked golfer in the world. As you know, people who play golf are typically affluent, so expect a lot more money flowing into the SoFi system. Whatever it is, all these recent partnerships should significantly increase brand awareness and attract a meaningful number of consumers into the SoFi platform. Ultimately, this should translate to strong revenue and earnings growth in 2024 and beyond, which should push the stock higher from here. In terms of valuation, SoFi trades at an EV to revenue multiple of 4.5 times and price to tangible book ratio of about 2.2 times, which is pretty cheap considering its growth profile as well as how expensively the stock used to trade a few years back. In terms of price targets, analysts have an average price target of $9.34, which offers an upside potential of about 27%. As for me, my valuation model returned an intrinsic value per share of $14.39, which is almost double from its current price of $7.33. That being said, I think SoFi stock is quite undervalued with massive growth and profit expansion opportunities ahead, making SoFi a compelling buy at current prices. So just to close out this video, one thing common about the three stocks that I just shared with you is that all three of them have been major underperformers over the last few years. More specifically, they are all down by more than 70% from their all-time highs, as you can see right here. For me, I think the greatest buying opportunities come when the stocks of high quality companies like PayPal, Grab, and SoFi are beaten down so much that people just don't care about them anymore. They just fear owning these kinds of stocks because the chart looks so bad that they think that it's just going to go down even more. I think it's a great time to take advantage of these situations because you're likely to be buying these stocks at very attractive valuations. So for all the reasons that I've laid out in this video, I'm a buyer of these stocks that I've just mentioned. And with that being said, this is the end of the video. I hope you enjoyed this video, and if you do, please leave a like and subscribe to my channel for more content like this. My question to you is, which stocks have you been buying recently? I would love to hear your picks in the comment section down below. And with that said, I'll see you guys in the next video.